Hi guys, here's Doc's Market Minute for Monday, February 29th, Sadie Hawkins Day. So what I want to show you today is the reasoning and the setup behind something that I have not gotten a chance to trade very much lately, which is a time spread or calendar spread, which is a longer term trade like that. So typically what you want to do with time spreads is, because they are long vega, and we'll talk about that in just a minute, is that you typically want to be trading these during uptrends where we're just about pausing and maybe we're about to go sideways for a little bit. Well, guess what? What do we have down here? We have the price up against resistance and maybe a little bit more longer term resistance up here at 200, but right now is at resistance because of the way that we had a key reversal bar on Friday. And we have exhaustion coming into the daily chart after this extremely strong move off the bottom here in just a few days. And so what I'm expecting to see is between now and perhaps next week, price is going sideways, maybe a little bit down, but generally kind of trading within a range, at least maybe now until the employment report, which is this Friday. Now, the other thing that I like about current conditions right now is that we have an IV percentile of about 28%. So over the last 252 days of trading, which is the last year, the current value of implied volatility right now ranks 28 out of, from 0 to 100, ranks the 28th percentile. So the important thing here is that it's not too high. We don't want to be buying too much vol at these levels, right? Because if the price ends up going higher from here, perhaps it goes up to that 200 level. I don't want the trade being crushed from that. So now what I want to do is, let's go ahead and look at the setup for this trade. So this is what's called a calendar spread, and we set it up right at the money. And the most powerful reason why this trade works is because we are setting it up right at the money. The greatest amount of time value decay that you're going to get is right at the money. So those of you that understand the effects of theta, or time value decay, this is positive theta, so this trade is making me $20 a day in time value decay. Now it's also long vega, so we don't want to be, what this means is that the value of the trade will actually increase as the overall volatility of the position increases. And what this means is that actually you can see the expiration curve of this trade actually change, whether or not the volatility goes up or whether it goes down. So what we want to avoid is getting in too early before a market finishes off with its final rally, which usually crushes implied volatility. So the fact that we got into this trade with a 28 percentile means that it doesn't have much further to go to the downside, or at least we're starting from a good location that even if it does crush just a little bit, it's not going to completely kill the trade. Again, what we're after here is to get in, get out, get our fair share. Now, in a perfect world, what occurs is that the price stays right in this area just like I've designed, and we don't have to do anything. However, what we can do is, if the price continues to rally up here and gets within, I'd say usually 15% of the upper range of this trade, that what we can do is we can turn this into a double calendar and we extend our range by quite a bit. So if this is now the middle of the double calendar, we now have an enormous amount of range for this trade to work within. The cost to doing that is that we usually have to stay in for twice as long for a trade like that. So I want to see what I can do to stay in the original single calendar, and so a lot of that depends on me entering these at the right time. So this is one area where entering these at the right time is of paramount importance. Okay, I hope that helps. We'll talk more about this trade later on in the week as we get more of an update. Thanks for listening. See you tomorrow.